So in this video today, we are going to be doing a review of the Equity Multiple crowdfunded real estate investing platform. So over the last year and a half or so, I've been reviewing a lot of these different platforms and studying them and writing about them over on my blog known as Investing Simple. And we have a pretty comprehensive article over there on the top 9 best crowdfunded real estate platforms available right now in 2020. And Equity Multiple is one that has made our list. If you want to check out that full list, that's going to be down in the description below. Now, Equity Multiple is essentially a crowdfunded real estate platform that gives accredited investors access to institutional quality commercial real estate deals. So that is the very first thing that we have to make clear here about this platform, is that this is a platform for accredited investors only. If you guys are not familiar with what that means, I will put up the requirements on the screen right now. So you have to meet these qualifications in order to be an accredited investor. So many of these real estate platforms offer you the option to invest in what is called a private placement, which is an individual real estate property rather than a portfolio of different properties. And the SEC has determined that these investments are higher risk and higher potential return, but as a result, the average retail investor should not be investing in them. So because this is a higher risk and higher potential return investment, the SEC has restricted it to accredited investors only. Now, there is a link in the description below if you guys do decide to sign up for Equity Multiple. It is an affiliate link, so if you do use it, I may earn a small commission in the process. Totally optional on your end, but it is a way to give back to me for putting this video together for you. So a lot of these different crowdfunded real estate platforms out there are pretty new because this has only been a legal form of raising capital since 2012. So you're looking at a lot of these platforms out there like Fundrise or Realty Mogul or Rich Uncles, and you may notice that they don't have a long track record or operating history. Well, that is one of the benefits here of investing with Equity Multiple, and that is the fact that they are actually backed by a leading national real estate firm known as Mission Capital, which has been around since 2002. So while a lot of these platforms don't have a lot of track record and operating history in this business, Equity Multiple is backed by a company that does have track record and does have some skin in the game here and a good amount of operating history. So if you're looking at the Equity Multiple platform, you will see an array of different properties that you can invest in. But just how do those properties end up on that website? Let's go ahead and answer that now. So this is how the process works for properties that are listed on Equity Multiple. First of all, trusted partners are going to source investment opportunities and essentially put these in front of the Equity Multiple team. The next step is that the Equity Multiple team is going to vet the properties as well as the local real estate market where that property is located. After that, they are going to stress test the properties under a variety of conditions, and what they say on their website is that less than 5% of the properties they look at are actually accepted and then available on their platform. And then the 5% of properties that are accepted are then listed on the platform and available to investors. Now, as far as the different real estate deals offered on Equity Multiple, they say they have 3 different types available to investors, and each have a different risk and reward profile. The first type is equity, which has a higher upside but also has a higher risk. So unlike debt investors, you have an uncapped potential upside. So if this property doubled in value, your investment could double in value as well, whereas a debt investor doesn't have any potential upside with that investment because they simply earn the interest from that loan, whether it be a fixed rate or a variable rate. However, the downside to this is that the equity investors are going to be the last to get paid in any kind of liquidation situation. So that is the advantage that debt investors have, is that they are first to get paid if they have that first lien position on the mortgage. So because of that higher potential return, it also has the highest risk as well, which does suit some investors, but maybe somebody who's a little bit older may not be looking for that type of risk in their portfolio. The second type of deal on the platform is called preferred equity, and these investors are paid before equity investors and project sponsors, giving you more downside protection. So if there was some kind of liquidation situation that occurred, preferred equity is going to be paid before deal sponsors or regular equity investors, giving you some level of protection there as far as what would happen in a worst case scenario. Now, as a preferred equity investor, you do get fixed monthly or quarterly returns, as well as a fixed portion of the project upside. So you won't get all the upside that you would as a regular equity investor. You will get some of that upside, but you will also have some downside protection because you are further ahead in line than the deal sponsors and regular equity investors in terms of who is getting paid first. And then the final type of deal on the platform is called syndicated debt, which has the most downside protection. And because it is the safest investment, it is going to be a lower potential return. So each loan that you invest in is going to be a first lien loan, which means you are first in line to get paid in a liquidation type situation if that were to arise. However, since this is a debt investment and you are not an equity owner in the property, you do not have any of the potential upside in terms of asset appreciation. So if the building doubled in value, it doesn't matter as a debt investor because you are just getting that fixed or variable interest as the banker for that project. So now let's cover a few other things that you should know about the equity multiple investing platform. First of all, the minimum investment to get started is going to be $5,000. The next thing you may want to know is what is the fee structure like for Equity Multiple? Well, most of these platforms charge an annual asset management fee of around 1%. Now, Equity Multiple actually charges a much lower fee of just 0.5%. However, they do also receive 10% of the investor profits as well. So some people are a fan of this type of structure because in this sense, Equity Multiple and your goals are aligned, which is essentially to make money. So overall, Equity Multiple seems like a pretty solid platform out there for accredited investors looking to invest in high quality real estate deals. And I really like the fact that they are backed by Mission Capital, which has, over a decade and a half of experience in the real estate industry. And this is not something we've seen with many other crowdfunded platforms out there because these are newly formed companies. It's also great that they offer a variety of different deals on the platform that are going to suit different risk appetites. So if you're looking for higher risk, higher return, you have equity investments. If you're looking for lower risk, lower return, they offer debt investments as well and projects in between. So there's a variety of different options that you have available to you. One thing to keep in mind is that although that fee is lower than most other platforms out there, they do also get 10% of all of the profits they earn for investors. So you may or may not be a fan of that fee structure. And then, of course, there are a few things that you should understand about any crowdfunded real estate platform before you invest. First of all, you should understand that these are rather illiquid investments and that liquidity is not guaranteed. If you're looking for a highly liquid real estate investment, you should stick to your publicly traded REITs. However, these private investments often have a number of different advantages, and in many cases, they often have higher returns than these publicly traded REITs. But you do have to understand that as an investor, liquidity is not guaranteed, and you should be willing to stick around for the entire duration of that investment. And in most cases, that's going to be about a 5-year time horizon. However, it may be a shorter time horizon if this is a strictly debt investment. So if you want to learn more about Equity Multiple, the link is down in the description below, and you guys can learn more and see if this platform is a good fit for you. But thanks so much for watching this video. I hope you enjoyed it, and I will see you in the next one.